In this video, I'll be talking about stocks and taxes. I will discuss capital gains and dividends from stocks and how they affect your tax return. Spoiler alert, it's not that complicated once you understand how it works. I would encourage you to watch the entire video as I'll be giving tips on how to maximize your tax return, as well as provide tips, tricks, and rules on how to be more tax efficient. By the end of the video, you'll have a higher understanding of how stocks are taxed and be better prepared for your tax return. So if that sounds good to you, let's roll the intro. What is going on, friends? Hope you've been well and welcome back to my channel. Today I'll be discussing how buying and selling stocks affect your tax return. I will provide timestamps below on each section so it's easy to follow. Now, I know a lot of you have been investing in the past year and made a ton of profit, but now it's tax time and the tax man wants his cut.
No one ever sees me, I'm losing every battle.
Don't worry mate, it's not that bad. Brother Brian is here to guide you through. Before we get started, please note that although I am a financial accountant, I am not a qualified tax accountant, and the advice I give today is very general, so if you need help, please seek the advice of a professional tax accountant. Also, please note that tax returns are due at the end of October if you're completing them yourself, and if you're using a tax agent, they're due in May next year. Alright, so with that all out of the way, let's get straight into it. The first thing you need to be aware of is your tax bracket. Your tax bracket determines what percentage of tax you have to pay depending on your income. If you look at this table from the ATO site, most Australians will be on this third bracket. Just remember that your taxable income includes the money you receive from your work, any dividends you receive on stocks, and any capital gains. You also need to include 2% for the Medicare levy that every Australian has to pay to fund the cost of Australia's public health system, which we know as Medicare. Personally, I am happy to pay this tax because I think the public health system is one of the best things about living in Australia. So if you combine 32.5% with the extra 2%, then the average person would have to pay 34.5% on taxes over a certain threshold for any capital gains or dividends they receive in the financial year. So that is the percentage that you should keep in mind when thinking about selling stocks. Let's now talk about capital gains tax. A capital gains tax event occurs when you sell your stocks for a higher value than when you bought it. Say you were lucky enough to buy 100 shares of Afterpay on the 1st of July 2020 at $60 per share. You then sell all 100 shares on the 10th of April 2021 at $120 per share. You have now made a capital gain of $6,000, and that is the number you have to report to the ATO when completing your tax return. The ATO will then charge you the tax based on your tax bracket. For the average person, it will be around 34.5%, so you will be paying about $2,070 for that particular transaction. The good news is, in Australia, if you hold your stock for over 12 months, you'll receive a 50% capital gains discount. So if you were to hold onto these same shares for over 12 months and sold it for the same price, your capital gains will be $3,000 after the discount. You will pay approximately 34.5% as before, so it will be about $1,035. Some people confuse capital growth with capital gains. Capital growth is when your stock grows but you don't sell. In this case, you do not need to worry about paying taxes at all. It only becomes a capital gain when you realize the gain, or in other words, you sell. Like most things in life, you don't always win. Sometimes you have to sell a stock at a loss, and this is called a capital loss. Capital losses can offset any capital gains you have for the year. For example, if you made $1,000 gain on stock A, but a $1,000 loss on stock B, you will effectively pay no taxes for these two transactions. It is important to note that losses can be carried forward to offset future capital gains but cannot be used to offset personal tax. This means if you don't have any capital gains to offset in the financial year, you can carry it forward to offset any future capital gains. But you can't offset against your personal tax, such as income from your full-time job. According to the ATO site, there is no limit on how many years you can carry forward a capital loss. Alright, let's now talk about something called tax loss harvesting. Tax loss harvesting is a strategy a lot of investors use towards the end of the year to reduce their net capital gains so they end up paying less tax. If you have made a lot of gains during the year, it may be a good idea to evaluate your portfolio at around June to consider selling some underperformers to lock in the offset for the year. You might be thinking, what if I sell a stock on the 30th of June to lock in a loss and then buy it straight back the next day on the 1st of July? Not so fast! The ATO is very much aware of this, and this is where the wash sale rule comes in. The wash sale rule is when the ATO prevents investors from selling a stock in one financial year to take advantage of a capital loss event only to buy that stock again in the new financial year. The ATO will disallow the loss if the sole intention of the sale was to minimize tax. So don't try to be smart guys, you don't want to be on the ATO's naughty list. To get around this rule, some investors will buy a similar stock to the one that they sold. However, please check with a tax professional if you want to practice this strategy. Let's now talk about dividends. If you are invested in a stock that pays a dividend, you'll be probably paid about 2 to 4 times a year. You need to pay tax on this income based on your tax bracket as discussed earlier. It's also important to note that you still have to pay tax even if you reinvest your dividends. Let's now talk about franking credits. According to this article from CommSec, dividends are paid out of profits which have already been subject to Australian company tax, which is currently 30%. This means that shareholders receive a rebate for the tax paid by the company on profits distributed as dividends. These dividends are described as being franked. Franked dividends have a franking credit attached to them which represents the amount of tax the company has already paid. So simply put, the company is passing on the credit to you that they have already paid, which can be used to reduce your total tax payable. You are entitled to receive a credit for any tax the company has paid. If your top tax rate is less than the company's tax rate, the ATO will refund you the difference. It's a good idea to keep track of all the dividends you receive during the year. If you have shares in an ETF like VAS, which pays out dividends, then Vanguard will normally send you a letter or email every time there is a dividend payout. If you lost the mail, then you can check the records on your shares registry. To find the shares registry for your stock, just go to the ASX site and enter your stock. So in this example, I'll enter VAS. And if you scroll down, you'll see the share registry is computer shares. You should have already registered your shares when you bought it because that is the place you can change your address, bank account, and whether you want to reinvest your dividends. You will also find all your dividend history and paperwork there. So make sure to sign up if you haven't already. If you use the ATO software to complete your tax return, I find that these days they pre-fill your dividends history quite accurately. However, sometimes they miss out on the franking credits, so if they have missed it, then just manually enter them using the forms that you find. Alright, let's now complete a working example on Excel so it's hopefully easier for you to understand. Alright, so now we can see the tax bracket breakdown from the ATO site. Now this table is not 100% accurate. Obviously every person's tax return is different, but this is just an example for someone who was buying some stocks last year and wanted to have an idea of how they will be taxed. So you have your salary from your job, dividends, capital gains, and franking credits. It is important to note that not all dividend stocks provide franking credits, so you better check if they do. As you can see, your dividends and capital gains are lumped in with your salary to create your total taxable income. Since your total taxable income is $76,000 in this example, you'll fall into the third tax bracket on the table. You will be charged $15,167 on the $76,000 income. If you are curious how I got that figure, I've shown my calculations at the bottom here. Please also remember that every Australian is charged an additional 2% for Medicare levy. And as discussed earlier, franking credits are automatically taxed to the company and the company passes the credit on to you, so it helps reduce your total tax owed. I haven't included things like deductions since everyone will be different and I want to keep this example purely for people investing in shares. So you can see on the bottom that your total taxable amount for the year is approximately $16,687. Now don't worry, you are probably taxed every time you are paid at work during the year, so the amount you have to pay after tax return will be significantly less. The amount you should be worried about is how much you have to pay for your dividends and capital gains, because these aren't taxed until tax return. So next time you sell a stock, please keep this in mind to keep a provision to pay the tax man. Alright, so now you might be thinking, Brian, what if I own US shares? Well, don't worry, I got you covered. This is what you need to know. First thing to note is to buy US shares, you need to fill in a W-8 form. The W-8 form is a legal US document required by the IRS that allows foreign investors to claim tax benefits, including a reduced rate of withholding tax. This basically means that if you do not fill in this form, your US broker will withhold 30% of both your capital gains and dividends and pass it on to the IRS, who are the ATO version of the US. So it is in your best interest to fill out this form. Usually the broker that you use will automatically fill in this form for you during the application process. At least that's what Stake and Self-Wealth did, and they are the two brokers that I use to buy US stocks. The form will last for 3 years, and after that you just have to reapply. It's quite easy. In terms of capital gains and dividends tax for your US stocks, they are generally treated the same way as Australian stocks. Alright, so you might be feeling a bit overwhelmed with all the facts I'm throwing at you, but don't worry, there's an easier way to track all these things. And that is with a portfolio tracker called Sharesight. You can create a free account which will let you track up to 10 shares. This includes both Australian and US shares. This is how I track all my shares, and it'll save you so much time compared to tracking it all on an Excel spreadsheet, although I'm still guilty of doing this. The best thing about Sharesight is the reports you can run during tax time. The most relevant ones for stock investors during tax time is the taxable income report and capital gains tax report that you can run. Inside the report will be a list of all your transactions for the year, and you can type the numbers directly into your tax return or give it to your tax accountant to fill in for you. I'm not sponsored by Sharesight, but I just really like their service, so I'll link it down below for you to check out. By the way, if you have any tax questions, then leave a comment down below and I'll do my best to reply to you. To wrap things up, taxes are a part of life and cannot be avoided, so it is better to be prepared early rather than winging it and hoping for the best during tax time. So next time you plan to sell a stock, maybe consider waiting the 12 months to take advantage of the 50% capital gains discount. Also, if you do decide to sell, make sure you calculate the amount of tax you're likely to pay and keep the money in reserve for tax time. I hope you enjoyed this video. Please smash the like button if you did. And if I provided you some value, then please consider subscribing to my channel so I can provide more value for you in the future. So until next time, my name is Brian and I'll see you in the next video.